Welcome to the Energy Desk, a weekly series from Mobius Risk Group analyzing the macro and fundamental trends shaping global energy markets. To take a closer look at any topics discussed on today's episode, head over to our research archive at research.mobiusriskgroup.com. Let's dive in. All right, Zane, we're sitting here April 4th, post-tariff Wednesday, and how's it going up in Montana?
Fantastic. I can't help but go back and it was not Tariff Wednesday. It was Liberation Day. Doesn't everybody feel unbelievably liberated as the value of everything goes plummeting lower?
One side saying Liberation Day, and then I've seen another word. I don't know if you've seen what I'm talking about, but it's I don't know.
Is it not
whatever the opposite?
Is it not safe to say on here? No, I haven't seen the word. I don't know. You're being kind of vague.
I don't know. No, I can't remember it. Yeah, but anyway, go ahead.
Locked up day. Would that be the opposite of liberation?
Yeah, sure. Yeah.
Yeah. So I don't know. Quick, maybe stating the obvious, but pointing out what's happened since Wednesday afternoon. Pre-announcement, the commodity market regular sessions closed before I think it was a 3 p.m. Central announcement for the tariffs. The front of the WTI curve was trading just under $72, and now we are just under $62. So quite the calamitous dip, and it's certainly not oil. We'll talk about natural gas today a bit, I'm sure, while some might try to find some correlations between natural gas and the tariff news. My personal belief is Mother Nature has got a far bigger stick to swing than anybody that will ever sit atop the executive branch. Yeah. But when you look across the board, the dollar's down to 102. The Dow back under 40,000, S&P looking like it's making a fast run towards 5,000, NASDAQ under 16,000. Everything is down. Gold making a run back towards 3,000. I don't know. You find it's down. I'm sure something is up somewhere. It's just hard to...
The VIX. Yeah,
there we go.
Index.
There we go.
Yeah. That's up, 25, 30%. So... yeah, I think maybe we can start with just a brief recap. Obviously, I'm guessing most of the people listening to this have seen what's been announced with the reciprocal tariffs, but I think there's a few points in there that haven't really been reflected in a lot of the media commentary, so we can cover some of those. But Wednesday, we heard President Trump announce 10% baseline tariff on all countries taking effect April 5th, so Saturday. And then reciprocal tariffs, which were calculated by the exporting countries' trade surplus versus the U.S., divided by their exports to the U.S., and then divided by 2. So that's kind of the simplified formula that the U.S. Trade Representative and the Trump administration used. And, when they argued for that, I think it has some merit where the tariff calculation is pretty complex. So regardless, we have a range between 10 and 50%. I'll read out some of the big countries that we import a lot of goods from. So China is going to face a discounted reciprocal tariff of 34%, EU 20%, Vietnam 46%, Taiwan 32%, Japan 24%, India 26%, South Korea 25%. So, just reading that out, you see the impact, especially on those Asian export-centric markets. And I think the big reaction in equities definitely reflects the consumer good impact there. The other one that I think is worth mentioning on just the headline announcement from President Trump was the revocation of the cheaper shipping method that a lot of the cheaper consumer goods used to go from China to the U.S. You buy an Apple product, they're shipping that from China using basically the loophole to get through customs without having to pay additional tariffs or border tax. So, I think that's also a big one that people are paying attention to. It's going to make shipping those consumer goods quite a bit more expensive, potentially. But I think getting to the exemptions, this is what I think is probably most important for commodity markets. So Canadian, Mexican energy, we talked about this quite a bit, but the USMCA exemptions or the rules of origin. So if a good is produced in Canada, Mexico, it's going to still have that tariff-free
energy
going into the US.
So energy specific.
Yes. And so for most goods produced in those countries, and I think it's, obviously that applies to natural gas, crude, electricity. So those will continue to see 0%. And then the other one, the reciprocal tariff exemptions, I think some of those categories that are worth highlighting: copper, semiconductors, lumber. And then the quote that I think is really, it's unclear, and I think for a reason: energy and, quote, other certain minerals that are not available in the United States will be exempt from reciprocal tariffs. So I think that's a pretty broad exemption that will give a little bit of flexibility to say, hey, this, critical mineral, graphene, graphite, or whatever we need to produce XYZ good, we can add an exemption for that. So I think that's pretty important to recognize, because those few categories are going to be directing a lot of the inflation kind of reaction. So energy especially, and I'm sure we'll talk about it, but food will be an important one to monitor as well. But any, take on the headline announcement?
I think it's just chaos is the take. And I think we're seeing it, what to make of it. Is it really a slowdown in industrial activity in any of these places? I guess the implied change in equity markets, commodity markets, you name it, would be that because things are more expensive or will be more expensive due to these tariffs, less will be bought, which means less will be made. I don't know. To me, it feels like the jury would still be out. Like if you go back to, 2020, like did consumption go down? I mean, that's the story, but consumption went down as we look back in hindsight because you couldn't get it. Yeah. It wasn't available.
You have 2021 supply chain. Yeah.
So I don't know. I mean, and then because that's the other problem is like you hear, the former Vice President Pence coming out and saying this, and I guess Warren Buffett taking a similar stance. This is an act of war. This is the greatest peacetime tax on U.S. citizens. Well, if that's true, it assumes that you're actually paying the tax, which means the good is bought. If you're not buying the good, then the tax is not incurred. And that goes to like another interesting topic. I don't know whether to laugh, cry, or just scratch my head and stare up at the sky and wonder what if. But the idea that has also been floated, let's get rid of the IRS and go with the ERS. Instead of an internal revenue service where we're, taxing your dollars, we'll instead just tax the rest of the world.
Yeah.
Man.
Yeah, it's a pretty interesting question, because I think the debate I'm having internally is who really has the leverage in that negotiation. So for a U.S. importer, the U.S. consumer economy is just a massive engine for so many different foreign economies for GDP. So we, with our spending power, 70% of GDP ballpark comes from spending in the U.S. And so that spending power gives us a lot of leverage to say a Vietnamese exporter who, by the way, several years ago, to get around the tariffs on Chinese exports, moved operations from China to Vietnam, to Thailand, to Indonesia. And now they're exporting from Vietnam here. But I think that negotiation will really be the deciding factor. Who ends up paying the largest share of the tariff, or absorbing the largest share of the tariff? So I think that will be a big one to watch. I do think that the U.S. has more power in that negotiation than a lot of people are maybe recognizing, especially when you look at the outsized role that the U.S. plays in these foreign economies. We've talked about Canada.
Yeah, I mean, I hate to say it, but it's not stating the obvious. The whole plan in the first place was to remedy the trade imbalance, meaning dollars in, dollars out. So I think in some respects, everybody should agree on that. Maybe I'm too hopeful, but if we're buying more than, they are buying from us, then I think inherently you've got the leverage. Yeah. It's just it's a game of chicken. Who's, the pure economic, I guess, impact, who feels it more. Also, I guess maybe unfortunate isn't the right word, but inherently is going to be a function of consumer behavior as well. Which countries population, government, how free are you, I guess, is, where you are in that spectrum. But who decides, whether these tariffs, so if I'm a country that is being tariffed, my economic strength, my jobs, whether the pay in those jobs or the jobs themselves are, I guess, on the table now to be cut, pay or job itself. Does that impact my spending? In places where access to credit is near zero or zero, in theory, it has to. You don't have the dollar, you can't buy it.
Yeah.
But I just, I think there is such a wide spectrum of, and then currency comes into that too. We haven't even really talked about the currency effects of all of this, but how does this currency versus that currency cause shifts in where we're making things, where we're shipping things from to?
Right. And on that point, just kind of to take that home, a cheaper dollar is generally going to dissuade U.S. Importers from importing as much. If dollar's weaker, dollar's more expensive, that gives you more purchasing power to go to a place like China or Vietnam and say, hey, ship us this good and take advantage of that. And I think related is also making sure that people recognize how these export-centric economies are capturing value in this transaction. It's an economy of scale. And so if they're not able to produce and ship as many goods, their backlogs are going to build up. Their inventories are going to build up quite a bit. And so I think that's something that will begin to apply a lot of pressure. We'll see how people escalate. I think one of the interesting points on that too is just between Mexico and Canada, the different reactions. You have Claudia Sheinbaum coming out pretty quickly saying, hey, we're not going to retaliate. We're not going to escalate the situation with our own retaliatory measures. But then, Canada has, I've seen a few different examples, but saying that they're going to do some type of retaliation or reciprocal tariffs or escalatory moves. So it'll be interesting to see how different countries, different regions react to this. Have you seen anything that caught your eye?
I mean, the one with Scheinbaum, I'm trying to find more detail on it and haven't yet. So I guess stay tuned, listeners, for some write-up by Alex or myself, or maybe next week's podcast. The comment was made that Scheinbaum said that that Mexico would begin importing less U.S. natural gas. Man, I made that confusing. Let me start over. Claudia Sheinbaum comes out post-tariff news and says the expectation should be that Mexico will import less U.S. produced natural gas.
Interesting.
Why? Is it because they're making, is it the expectation that they will make less of something it is that they're making that requires the use of natural gas that is a good that's imported to the U.S.? Maybe. Maybe it's poking the bear a little bit. Certainly U.S. LNG exports, piped exports of gas to Mexico are, certainly in the border states, big economic drivers. Yeah, I don't know. We'll see how that happens. And then I kind of just go back to Mother Nature decides. Just for context for listeners, Mexico's consumption of U.S. natural gas is counter-seasonal, at least based on what we're used to here. Like U.S. consumption is highest in winter and lower in the summer. Obviously, at peak season, there's, can be more parity, but Mexico will take more U.S. natural gas in July than they will in January. In other words, if it's hot in Mexico and it's not rainy, are they really going to import less? I mean, it's going to be hard to tell. And then if it is cool and wet and they import less, people will freak out and say, oh, no, look, they said they were going to take less and they are.
Yeah.
But was that just because of weather?
Right. Yeah, maybe that's an opportunity to dig into some of this because before we hopped on, we were talking a little bit about, the LNG and different reactions actually after tariffs. So I don't know if you want to do the LNG terminals or if you want to talk about, crude and natural gas price reactions post-tariff.
Yeah, let's jump to gas for a minute. I feel like gas is always a stepchild, even with the two of us. Poor natural gas. So currently, we've had quite the volatile week for natural gas. I don't think it has had anything to do with tariffs personally. Here we are, as you said earlier, Friday, April 4th. In the AM hours, cash markets have opened up. The weekend is trading near $4 at the hub, or at least it was last time I looked. But the front month contract, the May NYMEX natural gas contract is back sub 390, 387 these 30 seconds. It's traded as high as almost 425 this week. And we've been at this level. So at least as it stands at this moment, looks like we'll end the weeks on the lows. Some big seesaws, 30-cent travel peak to trough several times this week. And here we are back on the bottom end. And it's really Mother Nature driven. There's been a lot of questions that we've gotten lately about the back of the curve. We talked about it a little bit last week with liquidity. But there's another interesting one as it relates to LNG. And we'll try to tie these together with tariffs. So who are the big importers of U.S. LNG? Well, it can change seasonally, but generally speaking, Japan, at times it has been China, Europe, unquestionably, since the 2022 BTU crisis. Mm-hmm. And so you think about
South Korea a little bit.
South Korea, sorry, thank you. And you got a sprinkling, interestingly, of some Middle Eastern countries that will take some meaningful volumes. India, Pakistan. Yeah. So, the list is long. Will anyone take a stance with regards to U.S. LNG? I think what we've already seen is comments by India and, actions by China that say, maybe not, let's reduce this tax on U.S. LNG, or let's bring in less LNG. That would be, I guess, India and China respectively. And at the end of the day, if the fuel is needed to heat homes, to cool homes, to run heavy industry, it's going to be brought in. I guess the point I wanted to get to here is, the question that's been asked a lot is, will the build out of the Qatari LNG, it's been many years in the making. I mean, we've known for 4 years that the Northfield East
expansion.
Yeah. I mean, was a 20, I guess really 18, 19 is when it was first talked about. Like ships sailed in 21. It's coming, late 27, or I guess really beginning in 26, but through late 27, there will be a significant ramp in the available supercooled natural gas coming out of the Middle East via Qatari terminals. And the question is, are we going to have too much LNG in the world? Is that why the back of the curve is weaker than the front? And our answer is an unequivocal no. Ask me again 10 times and I'm going to say no 10 more times. Why is the back weaker? Because of liquidity and because there is a rational view right now that maybe we don't have enough. Shape of the curve is more important than flat price. People have this tendency to fixate on a value and say, well, this value is lower. The market must believe that fundamentally something is worse out there. Not necessarily. It may be that somebody believes that something is just better in the near term. How do I exercise that view? Just an outright getting long the front can be really dangerous and have one blow through VAR limits in a hurry. A spread trade is far safer. In some ways, I think you can kind of see that in equity markets right now. It's, like you said earlier, the only thing that's up is the VIX. And so how can traders be in like an uproar or turmoil if there is volatility? A trader has no ability to extract value without volatility. And so what it kind of unmasks is, maybe in equity markets and some of the metals, there was just this outright long that had been put on by enough that are now being, forced to run for the hills. Right. And so the LNG story, I think it's more related to the need for megawatts. We need electrons everywhere around the world. Gas is a readily available fuel source to make that happen. And I personally look at the liquefaction build out globally and the regas build out globally, near enough each other that it doesn't feel like we're going to have too much. And then if anything, it should also be understood that all of these regas facilities, and for that matter, liquefaction facilities, become storage. I got a giant round bubble on either end of it. And that has been the one thing that the world's needed most, is more ability to store a hydrocarbon that is arguably the most difficult to store.
Yeah. Yeah. And then you talked about this a few weeks ago, the regas build out in Europe, how quickly that happened. And I think that's also an important one to recognize, is that maybe the speed, the timeline for each of those different projects is not necessarily the same. So when you have, Asia currently just churning coal, anybody who's interested in building out some of that regas capacity, India specifically coming to mind, I think that's maybe not easy to calculate at the moment.
Yeah. I just, generally speaking, I would say, I don't know, Mother Nature decides if we have too much LNG or not. I mean, one of the things that also comes up in that discussion that is rational, makes a lot of sense. It shouldn't be so much, will this flood Europe with gas? And then the story goes on like, what if you restart Nord Stream? Well, I don't know. It goes to Germany, so I guess Germany's got to be on board. But will it lower flat price levels? I don't know. What I do know, or I do know, I guess I don't really know anything. I do believe that the spread between European and Asian gas markets and the U.S. market would narrow. When we first got this whole thing going, meaning the export of U.S. LNG, we were trading far closer to, call it shipping economics. I don't know, $2 to $4 an MMBTU, depends on your time. Cost of liquefaction is really a sunk cost. So, should the spread narrow? Probably. But, to what degree? I guess Mother Nature decides that too. Yeah. There's no reason for it to be $10 wide in perpetuity if you are building an adequate amount of liquefaction and regas capacity. And that's what allows them to get built in the first place, right? Like, it has to blow out to some extreme level to have somebody say, please build me another one. I'll finance it. I'll sign up for the capacity for 20 years. And inherently, when there's this dire need for some form of new, energy infrastructure shows up, those that finance the build out are usually the big losers, whether it's a pipeline moving a hydrocarbon from A to B, or railroad, it solves the problem. It's kind of self-fulfilling prophecy. Build the thing to solve the problem, and then the problem goes away and you're stuck with the bill. And ideally at some point it kind of goes back the other way and you get to extract some value, some extrinsic, no longer intrinsic.
Yeah. Yeah, no, I think that's interesting. And then, this week, as you mentioned, natural gas come off, but it seems more weather driven. On the weather front, I think maybe there's an interesting, just brief tangent there on the old here in the U.S. Is there anything here that we should be paying attention to that you see?
I think it's a good tie to a little nugget you threw out earlier. This cold that's hit I'll call it kind of the entire Midwest. I think the really interesting thing is the time that it's showing up and the impact that it could have on the ag sector. This is like prime planting time in a lot of areas that are getting hammered by some ice storms, some cold, some incredible wind damage. With a lot of these nations on the list, we're big importers of food products. I don't know. To me, this is the most interesting. More than the impact on natural gas is what is the far-reaching, meaning 9 months from now, what are we talking about in terms of food prices?
Right. Yeah, and so the obvious fear would be, we just have, we had prospective planting numbers come out this week actually on Monday. So for corn, 95.3 roughly million acres versus 90 million last year. So, we see some of these numbers, but the fear is obviously a cold snap comes in, rain, wind, and disrupts any share of that. And all your U.S. grains are going to be potentially in trouble. But
this system rolled through Canada too.
Right.
So did it, how did it? And
same thing for them.
Right.
Yeah.
This in the, NYMEX natural gas sphere alone, inventory levels are not nearly as dire a situation as it looked like they might have been a month ago. We've beat that drum. Probably, maybe it should be the last time, and we should just start talking about summer. But we end the winter with a little less than 1.8 TCF in the ground. I don't know, just kind of fun history lesson. The last time we were near the same end of winter inventory level was 2021. March of 2021, we had 1.784 TCF in the ground. March of 2025, 1.773. So pretty near. And then what happened after? In some ways, I think the market is trading as if and believes that we could be tracking towards another late 21, 22 like environment. And that's fair. We've honestly been undersupplied for many years now on a weather adjusted basis. And at this point, no one's even going to venture a guess on next winter's weather. So our, stance right now is that the premium placed in summer 25 or winter 25, 26 isn't irrational. However, it may be a bit overdone in terms of the magnitude. There's plenty that we see on underlying supply and demand domestically right now that is not a favorable signal. And then there's that wrinkle kind of putting these two topics, LNG, Europe, US together.
Yeah.
The European inventory levels, I don't know, do you have the latest on European inventory?
Yeah, I've got how they closed out the winter. So EU aggregate finished about 33% full year over year change, roughly 960 BCF, and end of season looking at 1.3 TCF in aggregate storage. And I think some of the the larger economies in there are interesting to look at too. You look at Germany, and they rounded out about 28% full, so 245 BCF. So that's historically among the lows for Germany. So quite a bit for them to refill. And, again, they have that EU Commission mandate for 90% full by November with some leniency to say, hey, we're not going to get there by November, maybe December 1st. But that's really the big fear for a lot of these EU storage operators, as we've discussed. It's just turning into forced buyers when the opportunity is not really ripe for buying. So we saw that in February, but I think the weather and renewable output kind of saved Europe from the worst of what could have been.
Let's stick with that number for a second. So let's just use around 900. 900 BCF less gas year over year. I mean, if you just say, all right, most LNG cargoes are, 3 BCF, 4 BCF on one of these VLGCs. So let's just use the high side 4. And I don't think any of them really get there, but admittedly, I don't pay very close attention anymore to how much is loaded on each boat. But I've got a significant increase in the number of cargoes, right? Take 900 BCF, divide it by 4, and, I've got quite a few additional cargoes that I'm going to need to get back to the same level. And, like he's pointed out, maybe they don't want to get to the same level. But the point being, in the near term, if we didn't have any impact last year, if there wasn't, air quote, too much gas in the Atlantic basin last year, well, there certainly isn't this year. So, while there seems to be quite a few headwinds domestically for natural gas prices, the Europe refill requirement is an interesting counter to that. Personally, I think that's part of the volatility this week, is you find pockets of someone coming in to, buy the hub, sell something downstream, or just buy the hub. Yeah.
Yeah. I mean, last year on November 1st, you had EU aggregate at 3.7 PCF, and 23, 24, you had about 3.8, 3.9. So yeah, quite a bit to refill. And, I think the other side of that is this is really the first injection season without any material Russian pipeline gas. So we'll see what happens with the Russia-Ukraine U.S. ceasefire negotiations and all of the related processes, but definitely puts a lot of pressure, I think, on U.S. LNG, Norwegian gas pipelines, Norwegian LNG, and Qatari LNG to fill that gap, because that's kind of Europe's list now. I don't know if there's anybody I'm missing on that.
Well, I mean, interesting, the Qataris, right? I mean, that I think is a story now and can be a story later. Like, there's some recontracting coming up. I think Pakistan has some contracts that are rolling off. India does too. They're big buyers of Qatari gas. You just think the proximity, it makes sense. And the Qatari gas is still priced off of oil, priced off of Brent, which is the pricing mechanism for most global LNG, even to date, that's non-US. So, buyers in China and India that have had access to essentially Henry Hub gas plus plenty, but buying hub gas versus buying a Brent-linked molecule. It's an interesting one where will Europe become the leading buyer of Qatari gas, and then does more of our product flow to Asia than Europe as it stands today? I don't know.
Yeah, it is an interesting question. I thought that was the contract side of that was really fascinating when the Biden administration had that moratorium announced on U.S. LNG to non-free trade agreement trade partners. That was an interesting time because Qatar was signing their contracts for the Northfield expansion en masse during that period. So really an interesting time for, I think, U.S. LNG coming into that picture. Yeah. On, the oil tariff side, the other piece that came in this week was OPEC's quote unquote surprise to bring on, I believe it was like 420,000 barrels per day in May.
What a kick in the pants yesterday for the domestic oil producer, man. So things weren't bad enough with the tariff news. Then you get OPEC coming out of their April 3rd meeting, which, according to news reports, was a heated one where all members eventually ceded to the wishes of the Saudis and Russia, and that being, hey, let's just bring some of these volumes forward. There's a couple of interesting wrinkles here. So yes, the 400,000, essentially what they did, and they issued a table. So you got to the OPEC numbers, and the by country for the 8 members of the voluntary cut crew, literally what they did is they took the July volumes and moved them up to May. There's no interesting wrinkle there. They just took the already published July output targets, moved them up to May. And so the market freaks out and goes, whoa, it's coming sooner. Well, I think there's a couple of really important unknowns in there. One, does that mean from that point forward, it's a slower path? Meaning, do I take now the new May, the old July, and is June going to equal what was the August number? Are we just like expediting this ramp? That's not clear. From the public statement is we reserve the right to slow down, speed up, completely go back to where we were. And then the other piece that is really interesting to me is in the language, it says, and this expediting of faster increases may help to bring those overproducing countries into compliance. So that's the nugget that I love is like, did you actually raise it because now you just like it's clear they're not going to make up for it. So you raise the target. They keep producing exactly what they are. It looks like they're making up for it, but they just haven't changed anything.
Yeah.
I don't know.
Yeah. It is an interesting one because we also right now, provide an opportunity for the participating countries to accelerate their compensation.
Right.
Yeah. Right now we also have Russia coming down on Kazakh overproduction. So part of that is the CPC. So the Caspian Pipeline Consortium, I believe it's Chevron is really one of the bigger parties for foreign oil companies operating there. But they just brought on a bunch of new production. I believe it was 250,000 barrels per day. So that has been a point of contention among the DOC members of how do you rein in Kazakhstan? You have Russia saying, hey, you guys have to cut exports to bring this back in line with what we've pledged. I don't know. What do you think? Does that change anything for Kazakhstan? Or
I don't know. My view on Kazakhstan is it's Kazakhstan or Venezuela. If Venezuela gets turned off, Kazakhstan stays where it is. If Kazakhstan comes down, Venezuela stays where it is. The love-hate triangle, Chevron, Russia. One of the things that was fascinating to me with the latest production numbers out of Kazakhstan, yet a new league record in March, remember that we had 2 Caspian pipeline outages in March. So, the idea at the time, there would be these short-term oil price spikes. Oh, there's going to be less oil coming out of Kazakhstan. This pipeline's down. We're not going to be able to export out of the Black Sea. And yet, clearly, they must have resolved those pretty fast. Do
you have that number in front of you? What was
I think the oil production number, I don't. I'm going to guess, but so you can go back and edit me in some show notes or something. 1.8 million barrels a day. So, essentially well over, I think maybe it was 1.7. So it's like 400,000 over target.
Yeah, required production that they show on OPEC for May with this update is 1.486. So
got a long way to go.
Yeah, we'll see.
And the UAE, consistently clicking along at often a 200,000 barrel. I still, it's amazing to me how they get to just fly below the radar. Overproduce. Nobody's mad at the UAE. Yeah,
lots of projects going on for them too. So I think that they're pretty interested in bringing those actually online. Refinery and production. So yeah, that's interesting. And then, on the tariff side, the reaction, I guess tariff plus OPEC, the reaction for domestic crude seems pretty interesting to me because my take on, cutting $10 over 2 days is that just the very strong demand expectation. So people are saying, hey, tariffs are just going to cut demand, crude demand, refined product demand.
I think that was, when you just look at the initial reaction, because products were down more than crude was on day one, which I'm going to call yesterday, April 3rd, even though they came out on the 2nd, it was aftermarket. So products fell more than TI did. So yes, I think that's the view. Today, not so much. You got products just kind of moving in lockstep with TI. We've, got down as much as a little more than $6 day over day for the front month TI contract, and looking at the, May gasoline and the May distillate crack, they were just pretty steady. I mean, that's the only thing you can really read into any of this right now is this is going to be a big demand killer, which then there's like that interesting thing, like, okay, but then if prices go lower, doesn't that incentivize demand? Like, are we?
Right. Yeah. There's a lot of interesting stuff. I think the questions that I have, the big questions is, all right, the timing of the tariffs is, I think, important to recognize considering the state of emerging technology and the capabilities of that technology, and with yields coming down. So there's two things there. Yields are coming off. U.S. has a big problem right now paying the interest payments on our 35.2 or whatever trillion in federal debt. So as yields come down, that gives, federal government some breathing room and potentially less spending. So less inflationary pressure from government spending. So that's one thing that I'm curious to watch. Second one is looking at the state of, say, AI and robotics. I think we're kind of on that cusp where potentially the U.S. administration is saying, if we just get a little bit of a catalyst here to, what's the difference between our ability to produce goods in the U.S. with robotics and AI providing leverage to our existing labor force versus outsourcing to cheaper labor in Vietnam, Thailand, Indonesia, and China? I think that's really kind of an interesting question because I've seen the rate of change for some of these manufacturing robots, humanoid robots, and some of these different applications. And you're starting to see quite a bit of, I think, those wow moments where, in BMW's auto manufacturing facility, I think in the East Coast, they've got some of these robotics doing test runs, and you see how they're operating on the manufacturing lines. It's nearing that point where I think that the U.S. can go down that path of robotics. So what is the change? What's the difference between that cost? I'm curious to see if that just accelerates some of the AI and robotics use cases for manufacturing in the U.S., where you don't necessarily need the labor force to get the leverage.
Well, what do you do with all these people? They're going to be angry if they don't have a job. It's going to be an interesting one. Or they have,
I think
the retraining. I mean, the other one that I think is fascinating there as you lay all of that out, I don't disagree. I guess I'm old enough that it scares me a little bit. Maybe when people get old, they just get scared of everything. But one of the fascinating ones to me is what's the food source? What do you need to feed a human worker? Well, all these grains, produce, proteins, diesel, gasoline for their vehicle to get to this job. This robot has to eat too. What does the robot eat? Mm-hmm. The robot eats electrons. Exactly. The robot eats a megawatt.
Exactly. Yeah. And those battery packs, I just did back of the napkin math a while back, and those robots are roughly about 7 kilowatt battery packs.
Mm-hmm.
So, just thinking about the U.S. labor force, you potentially have quite a bit of demand that's not really, I think, captured in most modeling right now in this case, say robotics does take off.
Yeah.
And I think that's really the thing. Right now, you have manufacturers in the U.S. struggling to find skilled labor or labor that sticks around long enough to train. So there is a lot of pent-up demand for something that gives them that flexibility, that it's not purely going to be robotics. It's going to be human in the loop type of manufacturing.
Yeah. I mean, essentially what you're talking about is we don't change anything. All of the jobs that are currently filled now are still filled. We're actually just increasing productive capacity, and robots or AI, I guess everything under that umbrella is what allows us to become a less of a imbalanced consuming nation. I mean, you see this with the tariffs. I guess maybe this is where we're coming to our conclusion. We consume far more than we produce, thus all of the trade imbalances. So is what you're outlining the path to, I guess, is it what's next on this financial engineering, political maneuvering path to try to rectify some imbalances financially? Do we get to be more self-sustaining through changing the way we do things?
Yeah, actually, I just pulled up the numbers for this. So I think just a brief cover. So I just calculated using lost man hours. So the man hours that manufacturers, industrial sector wants to be operating but cannot because they don't have the labor to do it. So these numbers are from a combination of Federal Reserve St. Louis and others. But if you have 50% robotics capturing those lost man hours, so just purely the ones that are not productive currently, you're going to add about 3 billion kilowatt hours. So that would be, total U.S. consumption was 4,100 billion, so 4 trillion kilowatt hours. Mm-hmm. And so, a small percentage, but that's only calculating lost man hours.
Right. That's
when you look at
what could be done. Yeah.
Yeah. Existing man hours and lost man hours, it would be about 55 billion kilowatt hours. So, it's just incremental from all of these different sources. And I think that those are potentially underappreciated. Just like you look at the, emerging sources from, Elon launching his freaking rockets, and each one of those is 62 million cubic feet of natural gas. So, it's just another source of demand that's new, under-recognized. And as they push to be, the freight transportation method of the future for between going to space, but also just supersonic transportation around Earth, I think that the demand potential is pretty large.
Fantastic conclusion as we end on that. It seems like we need more, while markets far and wide would say we're going to have less, or we need less.
Buying opportunity.
Right, exactly.
Yeah.
I wouldn't want to be short here. That meaning liquids complex.
Yeah. Yeah. All right. Well, sweet. Well, I think that was fun. It's fun to talk about some of this stuff. And we'll get together again maybe next week and break down anything else we see between now and then.
Sounds good. Hey, as much as I like talking to you, listeners, we're available. You can find us. We're not hard to find. If you've got a question, comment about anything we've discussed, come reach out to us, MobiusRiskGroup.com.
Yeah. All right. I'll see you next week.
Yeah.
Thanks for joining us at the Energy Desk. Again, this is a limited series. So if you want to hear more episodes, you'll have to let us know by hitting follow wherever you get your podcasts, or by sending me a message at amelvin@mobiusriskgroup.com. See you soon. And please keep in mind, this commentary contains our views and opinions and is based on information from sources we believe are reliable. This commentary is for informational purposes, should not be considered investment advice, and is not intended as an offer or solicitation with respect to the purchase and sale of commodity interests, or to serve as the basis for one to decide to execute derivatives or other transactions. This commentary is not considered promotional material.